write a little, 3-sentence summaries of it, you should be in good shape for the test. So this being said, I would like to start bonds possibly towards the end of today or on Wednesday. And I believe the next topic is bonds, right? Let me make sure.
So what chapter what number is that we're supposed to read on our own?
So the chapters you have to read for the next exam are 7, which is stock valuation, 9, market efficiency, and then 10 is behavioral finance. Yeah. So it's easy reading. I mean, it's not difficult stuff, but
So the exam will just be over those 3 chapters?
no, there is also bonds. That's why we need to get it started and move along. But the coverage of bonds we're going to do is very similar to what is done in Finance 33. So if you retain it from there, the leap you have to make is not going to be that massive. So we can do it relatively fast. But if I see that you're struggling, then that is the area where I need to slow down. Market efficiency and behavioral finance, those are simple concepts. It's a story, basically. And I don't think you need much explanation in there. All right, so what can you tell me about financial markets in the US? Are the prices, if investors are acting rationally, and the infrastructure to trade is well developed, what should happen to asset prices when information arrives?
They should react quickly and change to the
Investors
price.
should react very quickly and prices react and eventually stabilize to the new level, right? Very quickly. Is that what happens in US markets?
At least in
When
the first
information
year.
arrives, for the majority of instances, do prices adjust relatively quickly?
Yes, they do,
Yes.
because they're efficient in the semi-strong and the weak form.
So research shows that the markets are efficient in the semi-strong form, meaning that when information becomes public, investors react, and that information is then reflected in prices relatively quickly. There are though some instances where prices might take a little while to adjust. And in fact, those instances are so relatively few that I gave you some names of them. Think about how many pieces of information arrive in markets, but we're only able to identify, 5 anomalies? 5 or 6 anomalies? So for the remaining 5,000 types of information being released, markets are efficient. They found some exceptions. Can you tell me the name of one of the anomalies?
Asymptotes? No, the January effect.
No, up today is not your day. It's a bad stuff.
So January effect was. the
January effect,
classic
right?
one.
So the January effect.
Low PE ratio?
That's not.
Then there is the PE ratio anomaly, right? And so there are some instances where things don't quite work right. But I also told you that there might be some problems when you find those anomalies. There might be some problems that come from the methodologies used to conduct those studies. What are the 2 issues that I talked about?
Survivorship bias. was
One is the survivorship bias, and the other one is it's more technical than
I was
that.
thinking of the joint.
Hypothesis problem.
Joint hypothesis problem. When you say the word joint, make sure you continue
The
with
joint hypothesis,
hypothesis
yeah.
problem. Yeah, don't stop there. So,
The joint.
what is the issue with survivorship bias?
The companies that survive were likely already gonna be successful.
So by design, when you make a study, you collect a sample of companies, and typically, if some of those companies cease to exist within the time span you're doing the study,
Some merge, some get bankrupt.
some of them are going to be removed from the data set, right? And so implicitly, when you're doing a study using this approach, you're narrowing down your study not to all possible companies, but only to those who survived and did not fail in the time span. So your answers are your findings are going to be biased towards companies that actually made it, right? So they'll be too optimistic. What about the joint hypothesis problem? What is that?
It's like when you're benchmark or your standard is wrong from the beginning, and so what you're comparing, you're
So
cutting.
when you are
Yeah,
doing a
so-
study, you're looking at a comparison between the returns
Mhm.
produced by an asset
Is the model right?
relative to what the asset should have done.
Mhm.
And the relative part, the predicted part, rests on a specific financial model that you are employing.
Mhm.
So when you find that there is a discrepancy between the actual returns and those predicted by the model, you don't know if you found an actual anomaly or you found an instance where the model doesn't work. So every time you do tests using this methodology, you are implicitly doing two tests at the same time. Are there anomalies, and is the model working? And you will never be able to figure out which one is which. That's pretty much the whole idea, okay? So all those anomalies eventually paired with something else called bubbles. What's a bubble?
Like a little circle of things.
An illusion of growth that just keeps on growing when in reality there's actually no growth going on.
So it's an instance where an asset is mispriced
Significantly overpriced.
significantly for a long period of time, right? And so investors have plenty of time to figure out that this asset is overpriced, yet they keep buying it.
Mhm.
Like
And-
.com.
So that was one of the instances back in the days, and then what else? One more recent.
Oh, housing
Amazon?
wasn't recent though.
Oh, Bitcoin.
The housing market, perhaps, yes. What else? There is one more.
GameStop.
Hmm?
GameStop.
GameStop.
Yeah,
Remember
what's
that
it
story there? So, what about, there is one more.
Bitcoin?
Cryptocurrencies in general.
Cryptocurrencies, yes.
Bitcoin is one of the few that actually survived,
Yeah.
right? But there were many cryptocurrencies that
Crash.
their values, their price was incredibly high, skyrocketed over a very short period of time, and clearly that was not a good estimation of its value. I mean, it was a clear mispricing, but eventually they collapsed, right? And well, if you take the anomalies together with the bubbles, you might ask, are investors rational? So why are they not taking actions? If they discover that an asset is overpriced, in presence of a bubble, why don't they just short it?
Sunk
Why
cost
don't they
fallacy.
sell it if they have it? And most importantly, why do they keep buying it and drive the price up even higher?
Sunk cost fallacy?
So then we are getting in a slightly different direction than how investors think. So if you look at financial theory, which essentially is a spin-off of economic theory, essentially financial theory makes some assumptions to come up with the models that describe the relationships between prices and risk, the returns and risk, and all this stuff. One of the fundamental assumptions that they make is that investors care about risk and returns. This is the fundamental assumption of those models. I mean, keep in mind that if you want to come up with a mathematical model to explain how something behaves, you start with an incredibly high level simplification of how things work. So you assume that there is only two variables that play a role. Yes, there is more, but those you kind of ignore it when you start developing the model. If the kind of general model works, then maybe you start adding one more variable to it and make it a bit more precise. So this is the way mathematical models are developed. You start with very few variables, and then eventually you add more to the model. But every time you add one more variable to the model, what happens? Its complexity becomes considerably larger. So the perfect model is the one that strikes a balance between describing reality reasonably accurately, but it also is as simple as possible. That's the best possible model you can come up with. And when you develop financial theory, you want to explain how an incredibly large set of variables interact with each other. And the starting point is as simple as this. Okay, so you assume that investors care about risks and returns, but you also say that investors in general are risk averse. Risk averse. What does it mean that they are risk averse?
They avoid risk.
They avoid risk if they can, right? And so another way to frame that, what could convince an investor who only cares about two things, risks and returns, to take on an asset that has risk?
More returns.
The only way you can convince them to take on risk is if returns are high enough to compensate for the risk they're taking. In fact, if you think about how this ended, those assumptions, and there's a bunch of stuff going on, eventually you get to the capital asset pricing model that says that the returns of an asset are equal to the risk-free plus its systematic risk, the returns of the market minus the risk-free rate. So by making this set of assumptions, characterizing how investors think, and doing a bunch of stuff that took about 25 years, they arrived to this conclusion. Now, this conclusion is not coherent with the anomalies. And so there is a new field of finance that basically has blossomed in the past 20 years or so, called behavioral finance. And one of the things that they talk about is, well, maybe investors are not rational in terms of behaving based on those assumptions. Maybe there is something missing. Maybe we should characterize investors in a different way, more realistic way. Maybe investors care about other things besides risks and returns. And so they come up with a considerable list of reasons why investors may be rational in a way that is different than the way we have been thinking up to now. And so they say, well, investors have limits, cognitive limits, in terms of absorbing information and putting it together. And so if you use all the subset of the information that you're collecting, you might think that you're acting rationally, but in reality, if you actually look at the entire set of information that you're not considering, then your actions are totally irrational. An example of that could be, this is clearly not it, but just to give you a vague idea of what I'm talking about. Suppose I have I'm probably gonna mess this up, I guarantee you. Something like this, or I delete that. Can you tell me what is the trend here? If you only look at that?
Upwards.
So if by looking at only those green dots, the conclusion could be, well, the trend is this, right? So this is a rational prediction. But what if the green dots that you see is only a subset of the information that is here available? We're only considering that. There is some other information that is there, but we're not looking at it. And the missing information could be this. So this is reality, right? And so if I want to predict the next dot, what do you think is gonna be? If I use reality. Well, reality, if this is reality, and this is representative of it, this is the way reality is going to work. This should be my prediction. But if I only use a subset of information, even though I'm being rational, my prediction is going to be totally off. So this is where the behavioral finance guys step in, and they say, well, if we want to predict and come up with models that explain behavior in finance, the traditional models have been okay, but they failed in a number of occasions. One is the bubbles, one is the anomalies, and so forth. So how can we fix things? Well, let's try to understand how the human mind works first. And then perhaps from there we can come up with better models that can capture everything. And now, I'm gonna spoil the story here. The first papers in behavioral finance are back from the 90s or so. When I was in grad school, the behavioral finance was the next new thing. And as of today, they have not really been able to come up with a model that is significantly better than the capital asset pricing model. This was developed in 1966, a long time ago. Grandpa times. So just to give you an idea, that behavioralists have come up with concerns, they have come up with explanations they pointed in the direction where financial research needs to go, but as of now, they have not really come up with a model that is significantly better than something this simple from back in the 60s. So when you're given a lot of information, suppose I give you a problem to do in class right now, and I give you 5 minutes, and the writing of the problem is 3 pages long. And whether you pass the course or not depends on how you answer in that problem. You have 5 minutes of time. How can you handle it? What do you do?
5 minutes of time, huh?
So read very quickly
Yeah.
and not very carefully. I mean, it's just the way it is, and see if you can figure out what the story is. And if you read very carefully, a lot of information like that, most likely lots of information is useless. But if you are overloaded with information, you're likely to take shortcuts. And so the shortcuts is what behaviorists look at to explain how people could actually be acting in a way that appears to be rational, but in reality, I mean, in their mind is rational based on the shortcut, but in reality it's not. It's kind of the idea of the delusion right there. One of the important shortcuts is called anchoring. I'm not giving you a full list of things. That list is in the textbook, but this is probably one of the most interesting one, because it's actually exploited to mess with customers. So the idea of anchoring is that if you're facing a difficult problem to solve, where you have no clue how to do it, and you're asked to do evaluation, you tend to come up with a base value as a reference value, and then from there decide if from that base value things are better or worse. The problem is that in many cases you don't know what the base value is, and so somebody from outside gives it to you. For instance, suppose you go to a store and there is a rack full of these shirts for sale, okay? And they're on sale for $10. Is that a good deal?
Depends on what the original price was, I guess.
So your answer is, well, it depends what the original price was. And how do you know what the original price was?
Ask the store clerk.
So typically there is a tag with something called the MSRP,
Yeah.
right? And that MSRP perhaps is $50. So now you see this shirt, and on sale for $10. But the way you think is $10 is cheap compared to this number. So would you buy it now?
I really
Think
want it.
rationally. If the shirt is there, it's because nobody wanted it. So what is its value?
Zero.
Its value is clearly not these. And the $10 they're asking for it, if the shirt is still there, is also too much for it, isn't it? But the way you feel good about buying it is they create this anchor. So your mind now looks at this number. This is an anchor, I guess. I don't know. So this is your reference point, and now you see the actual value of it. Oh, that's not actual, like the actual price. And relative to that number, this is very little. So they're manipulating your perceptions purposely so that they can coerce you in one specific type of action. Have you been in the reading group? You're an econ major, right?
I never went to the reading group though.
Oh, disappointing. But this is one of the ways this anchoring is used. And so sometimes investors, if I have a stock priced at this level, and instead of doing a thorough analysis of whether I should keep it or not, the way I think of it is, well, I paid $90 for it. So perhaps I should sell it because I'm gonna capture a profit. And maybe this thing is actually worth $500. If you do a thorough analysis, maybe this thing is totally underpriced. And you should hold it, whether you pay 90 for it or 100, if it's worth $500, you should keep it. But many times investors use their purchasing prices or other things as an anchor, and their choices are not based on a thorough valuation, but based on their perception. And so that introduces some behavior that is not coherent with rationality. Does it make sense? Questions? All right, so know what behavioral finance is, know what are those biases, and know what are those shortcuts. Now the shortcuts are called heuristics. And those are little things that, little shortcuts that humans tend to take when facing complex decisions that need to be made. Questions? All right. So still part of this chapter, there is something called technical analysis, separate story. And this technical analysis basically is used to time the market. So basically to arrive to the decision whether you should buy an asset or not, or short. The way this technical analysis came about is from a number of assumptions, and there's a number of assumptions basically say that prices moving trends. So let's think about this assumption. There are trends in prices. Is this coherent with market efficiency?
Yes, because it reacts to news.
If there is a trend,
Mm-hmm.
It gives
that means
true-
that you can predict prices,
Yes.
right? And if you can predict prices, are markets efficient? So the way you can extract the trend is by looking at past information, right? So if markets are efficient, then there should not be trends in asset prices. So the assumptions that those guys are making is already at odds with the evidence that we're getting from market efficiency. So this is an assumption. Market efficiency provides you evidence. And so what are those trends? They identify basically just 3 types of trends: daily, then they have the secondary. They can be either weekly or monthly. And then they have the long-term trends, which are primary trends. Okay. So, if you can uncover those trends, then you can predict future movements, right? That's pretty much the whole point of that. Future movements of asset prices. If you can predict future movements, then that can tell you whether you should buy and sell a particular asset. So this is the intent of technical analysis. Those are the assumptions that they make, and this is the consequence of those assumptions. Now, how do they uncover those trends? They have a number of tools. Most of them are related to charting, and so they look at historical values and they employ something called a moving average. And the way you calculate the moving average is like this. This is time. Those are prices. And the moving average today of size n, this means average all prices from today to n days ago. So a moving average of 5 means what? You look at the prices today, 2 days ago, 3 days ago, 4 days ago, 5 days ago, right? So every day that you move forward, what happens? You acquire 1 more day in that average and you drop the one that is now 6 days old. Okay, so the number of days that you're using moves along with time. What happens when you do an average that is progressively composed of more and more numbers? What is the relative importance of a number if the sample size is 5 or if the sample size is 500?
The relative importance decreases.
So you're averaging, removing 1 unit, 1 figure out of 500, the impact is not gonna be that much, right? So if you have a short moving average, if n is small, then the moving average tends to be very reactive. But if you add numbers to the list, then the moving average does not react much by adding 1 number and moving another. So for instance, if I have a 5-day moving average here, a 5-day moving average, it kind of follows the price chart, but it's a little bit smoother. If I have a 50-day moving average, by the time there is a sudden change, it takes maybe 20 days for that sudden change to be reflected in the average. So if you have a long moving average, the long moving average kind of behaves like this. It's smoother and reacts at a lag. Okay, so it does not react much, meaning that it's smoother, reacts at a lag. Does it make sense? So one of the techniques that is used by technicians is to look at the intersection between the moving average and the prices, or perhaps looking at the intersections between two moving averages. And in terms of intuition, it can be quite impressive because you can easily see that there is a possible trading strategy that takes place, because if you look at this number, and if you look at this number, this could be a signal that I should sell the asset. This could be a signal that I should buy it. And this is a signal that I should do what? Sell it again. If you follow the intersections as signals to buy and sell, it's telling me, hey, sell it before it drops too much. Buy it because it's about to go up again. So this set of the set of intersections there, they seem to be really accurate in giving me a signal when I should buy and sell. Does it make sense? Do you agree with that? But let's think about this. How do I get this point on the red curve? That is a moving average of perhaps 100 days. So in order for me to calculate this one, I need to have information about the 100 days prior to it. Does it make sense? The problem is that what I don't know is what the actual price series is going to do next. If this is today, and so today is right here. Okay. I don't know what the price series is going to do next. What this graph has been able to do so far is give me a strategy I should have used in the past. It's not giving me any reliable information to figure out what to do next. The price series at this point is equally likely to go up or to go down. And if it goes up, then there is going to be another intersection. If it goes down, there is going to be no other intersection. So even though the graph seems to be a very reliable way to provide signals about trading, its implementation in real life is at best questionable. So make sure you know how to calculate the moving average. Make sure you know how to read this graph. But also be cautious if you're trading your own money. Be careful with this. It can be deceivingly good of a tool to predict what to do. Research has shown that actually this hasn't quite provided any information better than just investing in a broad index. An enhancement of that is something called the Bollinger Bands. So again, this is the price series, and the way you calculate the Bollinger Band is first start with the moving average. And you decide the length of the moving average and compute that. Then using that sample, compute the standard deviation of the prices contained in N. So like if I'm doing a 5-day moving average, I have those 5 prices included in it, then I compute the standard deviation using those 5 prices. So this is step 2. And then step 3, compute the upper level of the band by doing the moving average plus a number times the standard deviation of that, and then compute the lower level of the Bollinger Band by calculating the moving average minus the same number times the standard deviation of N. Okay, so on a particular day, instead of getting a single estimate of the moving averages, you're getting a range that goes from one number to another. So the moving average here will look like this. On any given day, those are the values of the moving average. And then for this particular day, you add one number to it, and you subtract one number to it, the standard deviation. So repeat that, and you end up with something that looks like this. This is your upper level. And this is your lower level. I didn't draw it right. Anyhow, they're kind of parallel to each other. However, the band is wider if there is more volatility in prices. The more the prices are jumping all over the place, the more the standard deviation is going to be, and the wider the band is going to get. Okay, so low volatility. You have a tight band, and high volatility. You have a large or a wide band. Questions? So how do they use this thing? Well, they kind of use it the same way as the moving averages, except this gives a little bit more information about volatility, adds a kind of a margin of error in your estimate. The problem is that you can arrive to completely different conclusions depending on how many days you add to the moving average and what multiple of the standard deviation you're adding to it. So paradoxically, you can actually find one strategy that tells you to buy on Tuesday when there is a particular intersection. But if I increase the number of days and I change the multiple here, I could come up with another set of indicators that tell me to do the exact opposite on Tuesday. Does it make sense? So there is an issue with these. And the main one is that The studies in market efficiency have shown that historical information does not provide any useful insight in order for you to trade and capture abnormal returns. But technical analysts are saying the complete opposite. If you give me a chart, I can use it and figure out something that you can't see. Does it make sense? So there's a big contrast. One is evidence, the other one is a claim. There is one more chart that I want you to pay attention to, and is a point and figure chart that looks like this. This is time, this is prices. And on a given day, you have a stick that represents a number of pieces of information about the prices of that asset. This one right here, the top part represents the high in which that asset was traded for that day. The bottom one is the low for that day. So the lowest intraday price for that particular asset. And then you have two bars, one bar to the left and one to the right. The one to the left represents the opening price. The one to the right represents the closing price. Okay? So what kind of information are you getting from this particular stock? Well, when it was first traded, it was trading at this. At the end of the day, the price was this much. Within the day, it reached the highest level of this much and the lowest level of that. Now, we don't know what happened first. We don't know anything about order. We just know the extremes of what has happened. So this essentially is just an enhancement of just the price chart. This is the price, perhaps the closing price of the particular stock. This instead gives you more information about what the stock has done throughout the day. Okay. Now, possibly those techniques can be applied here, but the same issue remains. Studies on market efficiency have shown that historical information, which is what you use in order to create any graph, is already reflected in stock prices. So using historical information to try to earn abnormal returns in an efficient market will not yield anything of relevance. Questions? So what are the implications of what you learned in about mutual funds, ETFs, market efficiency? Is timing the market an easy thing to do?
No.
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 So what about investing in a well-diversified fund and just walk away, then come back in 20 years and see what happened? Is that strategy better than trying to time the market, or worse?
Depends on how good you are.
I would assume a little bit.
So all those studies actually show that some of those mutual funds that might be employing those kind of techniques, maybe for some time they beat the average. But if you pick all those funds that have done very, very well, it's very unlikely they will keep beating the average. Some of them will actually do worse than the average. So they arrive to a conclusion, and the conclusion is you're probably better off just to join the average. The passive investment strategy is probably the one that exposes you to a relatively low amount of risk, is the least costly to do, to implement, and chances is going to do better, but almost for sure not worse than just taking an aggressive active trading strategy. Because timing the market correctly and possibly taking on additional risk is not going to compensate you enough over just investing in passive funds. So why is this stuff so popular? Because I mean, every time you watch something on the financial TV programs or anything like that, they always talk about technical analysis, right? They give you a bunch of indicators. Why? Even though market efficiency says the complete opposite, this is just garbage.
It's nice to make a quick buck really quick.
I only hear them ever talk about like the
Day trades
200-day
are rational.
moving average or something.
So they talk, but they use those, right? They say, oh, there is something is based on this is underpriced, or based on this is overvalued. This is a selling signal. They talk about something called resistance levels. I didn't talk about it right now, but those are all terms that come from the analysis of those type of charts. And to be trained to be a technician, essentially you have to read 3 books. To be trained to do research on market efficiency, you need to get a PhD, it's 4 years of schoolwork. And so there is a difference between the two.
Cost of entry.
One's easier.
Well, I mean, it's less demanding
Yeah.
and less of a commitment. Let's suppose you come to me to ask for financial advice, and I tell you, well, in order to get the advice, you need to give me 1% of your wealth. That's pretty much the cost of managing a fund. And maybe you have $100,000 in that account, that corresponds to $1,000, right? So you come to me and I tell you, oh, just invest in the SPDR, done. Are you gonna come back and give me another $1,000 next year? I would tell you the same thing, invest in the SPDR and T-bills. That's pretty much what the studies on market efficiency have shown, that that's the optimal strategy to take. Would those words be worth $1,000 a year? No. You come to me and I show you a bunch of crap like this. You get overwhelmed and you feel like, well, this guy must have worked for that $1,000, maybe he deserves it. I mean, you know what I mean? So there is a little bit of a perception. Ultimately, as a client, it's going to be very difficult for you to evaluate if my advice is actually good. If you came to me for advice, most likely you don't have to do the tools to assess my performance. And the moment I show you this stuff, you might think that I know some stuff that you don't know. That's my personal view, okay? This is my thing. It's not, I'm being very cynical about it. The reason why I have those particular views is because I read evidence about market efficiency, which is a bunch, and then there is not much to support that this stuff works. I did a study with one student years ago, and so we applied this different technique over like 20 years, 30 years or something like that. And the way we did it is I wanted to see which length moving average was better at predicting things. So we tried the moving average, we implemented a fake investment strategy. And so we used the moving average of 5 days to get signals, and based on that, we decided to buy or sell. Then we tried 6 days, and then 7, 8, 9, all the way to 200 days. And ultimately, we found that there was a lot of statistical noise. And so when you arrive to the conclusions that one particular strategy appeared to give more money, to give higher returns than the others, there was so much noise around it that it was very difficult to actually be confident that our findings were universally true. It was maybe just true because of the specific data set that we had used. So we tried on a different data set. We tried on American markets, we tried European indexes, we tried a bunch of different stuff. And we arrived to pretty much the same conclusions. The ones that appeared to work a little bit better were very short moving averages. The problem with short moving averages, if you look at the green line here, how many times it intersects the black line? A bunch. compared to the red one, right? The red one only intersects, what, 3 times, 4 times? So if the short moving average is the one that appears to work best, that means that you're gonna have a lot of signals where you have to buy and sell. And what can you tell me about buying and selling very often?
The fees.
Doesn't-
It's costly. It can be very costly. So we don't have a way to actually measure what the fees are in our study because we don't know what those numbers are. They may be different for every investor. So, but nonetheless, the fees will reduce your profitability. So even the instances where this technique appeared to work, it worked best when the strategy was very expensive to implement. So maybe in that case, maybe it was not going to work. There is one more thing besides fees. Taxes. If you realize a lot of capital gains, well, then all those capital gains will have to be taxed, right? So that is gonna take away a little bit more from that. But again, the study we did is just one that shows that this didn't work. And our intent when we were trying to do this study was not to prove whether this technique worked or not. Our intent was to find which time length worked best. That was the thing. And it turned out that pretty much overall they didn't seem to work at all, in practical terms. Does it make sense? Questions? So be careful with what you read. I don't know if I want to tell you this because I'm afraid that you're going to actually do it and then I'm going to get sued. But let's suppose I have 100 students. Okay. This is the set of my students. And I pick 2 stocks. And I pick the S&P, let's suppose those stocks have a better one. I pick a bunch of stocks with a better one. So in terms of risk, are equivalent to the market. And how could those stocks behave relative to the S&P? Well, one could do better than it, could do worse. But then the other one could do worse and bad. So let's suppose that I look at all possible scenarios where both, let's put a plus here, both of them outperform the market. Both of them underperform. A outperforms and B underperform. A underperform, B outperforms, right? How many outcomes are possible? 4? Did I leave anything out? Assuming that they don't tie with the market, okay? So they either do better or worse. That could be an instance that I ignored. But do you agree with that? Have I done any prediction? I just laid out all possible cases, right? So what I'm going to do is take those 4 outcomes, split my students in 4 groups. You guys get the first scenario, second scenario, third, fourth. Okay? Necessarily, I'm going to be right in one of those cases. Well, these are all the possible combinations. One of them will happen. So let's suppose this is the one that actually happens. Then next month, I'm going to tell those students, same thing. I pick 2 other stocks, C and D. Better one, so we can compare their performance with the S&P directly. And I look at all 4 possible cases. And scenario 1, 2, 3, and 4. Necessarily, one of them is going to be right. So now I have this group right here. What are the perceptions about my ability to guess or predict stock prices of those guys? Those guys are gonna say, this guy's an idiot, doesn't know what he's talking about, right? Those guys are gonna say pretty much the same thing. But on the first round, those guys may be interested now because they saw that I predicted stuff correctly. On the second round, those guys get, the first prediction was correct, but the second one wasn't. Those three groups. What about those? I was right both times, right on the spot. So what do you think I'm gonna do next?
Go make 4 groups again, I guess.
I send another letter to those guys and say, if you want the next prediction, it's for sale, $100. Are they willing to pay for it? If you believe that I'm gonna be right every time, I mean, you can make $100 in a heartbeat. Just invest, $10,000 in it. But what did I sell you?
Predictions.
Other
Nothing.
people's failure.
I mean, I sold you,
Sold
I
probabilities.
just
Sold.
gave you the answers that you wanted to hear, and I did not produce any predictions. So why am I telling you this story?
It's a really effective way to make money.
Is because this stuff actually happens.
Yeah.
And out of the many people that go on TV to make predictions based on whatever technique they have, perhaps technical analysis, perhaps whatever else, necessarily one of them is going to be right once in a while. That's it. I mean, if you listen to the TV, somebody's going to say, oh, markets are going to do well. There is some other dude saying markets are going to do poorly. One of the two is going to be right. Jim Cramer sometimes is right, sometimes is wrong. When he's wrong, he's not going to remind you of that. He's going to tell you, well, I was right last week. Yeah, what about the remaining 52 weeks where you screwed up? The point is that making those type of predictions, make those type of assessments is incredibly difficult. And but there is also opportunity for fraud to take place. This has been an example of it. Okay, so don't do that. So.
Remind me if I'm wrong, but didn't Enron also dabble in this a bit? Or am I thinking about something else?
What do you mean?
Like, do fraud like this?
No, they just did, from what I know, they just made up financial statements completely. They just invented stuff.
They just
And
went to the base level.
yeah. So they went a step further. Yeah. Questions?
So that's legal, right? Like, there's nothing like illegal about
Well,
it to where they can
it's a
go
matter
to
of
like a
intent.
crime.
In my case, if I were to do something like that, what is my intent? It's not to provide information to investors, it's to specifically
Make money off that group.
deceive them
Yeah.
and make money off of them.
Okay.
Right,
So
so
they could get in
from the
trouble.
legal point of view, I'm pretty sure that you.
He's more of a
would have
salesman.
problem.
Okay.
It's not quite a salesman. A salesman can sell you some garbage, but if he's promising you that it's not garbage, then there is fraud, right? And no, you're the ones who have taken business law, so you know this stuff way better than me.
Proving it
So-
would probably be hard.
Maybe it's a good question for if you're in business law. Ask them.
Mhm.
So I came up with this marketing strategy and see what that gets you. Questions? Don't put my name on it. So if it works, then we can figure something out.
Okay, sounds like.
All right. So read this chapter. What I want you to remember for practical reasons, be very skeptical. You're looking at two bodies of research that say contrasting things. Market efficiency is strongly supported by actual evidence. Those guys are making some claims, and those claims, many times, they're not supported. Also, there is something that they stand to gain. People believe that those techniques are worth something, and so you should be even more skeptical because of that. Then, if you get to somebody who appears to be a star investor, be aware of this. This is done intentionally, but if you think of this as a group of people that are making forecasts, and those forecasts are just random outcomes, eventually one small subgroup is going to be right, but not because of their ability to make forecasts, it's just because they guessed right, they want the lottery, that's right. Okay, so be skeptical when it comes to investing your own money on somebody else's. Questions? Bonds. So you need to step bonds. So remember, you have to read most of this stuff on your own. I'm going to give you some broad open-ended questions for you to focus on. And when is the next exam? Do you have a syllabus? The 6th?
I believe it's-
Yeah, there's no way it's going to be on the 6th. Sorry, that was the, yeah, if class, if I didn't have to cancel class, that would have been okay. But probably we're looking at, maybe 2 weeks after this Wednesday. So it's probably sliding about a week down. And we'll talk about it on Wednesday. Is that right?
Yeah.
Okay. So yeah, that's. Yeah, that's. Yeah, okay. Bonds. What is a bond?
What's the correct way to describe it?
Ownership?
It's not ownership.
Wait, no, that's
it's
the top.
Simple terms,
simple terms.
broad view of the bond.
Money you loan out to the company that they have to pay you back with discounts or.
That's what it is, but it's described in
Different words.
something. Come on,
Contract.
it's a contract.
Oh, okay.
A bond is a contract. Alright, what does this contract say?
You're giving them a certain amount of money and they're going to.
What the contract says that there is one side called the issuer of the bond that has a number of things they need to do. They have a number of obligations, right?
Mhm.
And in fact, another name for bonds is obligations. And in a bond, you have somebody called the issuer. And this issuer, basically, and the most generic type of bond contract, must make a series of payments to the holder of the contract. And now, what are those series of payments?